Welcome to English Easy Hub. Join us as we ignite the flames of your English learning journey together.
Please subscribe to watch and embark on your English learning journey. Don't miss out on the exciting content. In this engaging conversation between Jack and his father, they explore the scientific approach to investing in the stock market. The dialogue delves into various investment strategies, emphasizing data-driven decision-making, risk management, and the balance between fundamental and technical analysis. Jack, eager to learn, asks insightful questions, while his father provides thoughtful and deep explanations, touching on essential topics like emotional control, market noise, diversification, and even the impact of new technologies like AI on the stock market. This exchange illustrates a practical roadmap for those interested in investing systematically, without falling prey to emotional decisions or market volatility.
Dad, I've been doing some reading on investing in the stock market. A lot of people say that you should approach it scientifically, but I'm still not sure what that actually means. How do you invest scientifically?
That's a great question, Jack. Investing scientifically means relying on data, logic, and analysis rather than emotion or gut feelings. It starts with fundamental analysis, where you dig into a company's financial health, looking at its revenue, profits, debts, and the overall market conditions it's operating in. You want to understand if a company is making sound decisions and has potential for growth.
So, it's like evaluating the company as if you were buying the whole business, not just a stock, right?
Exactly. You're not just buying a stock ticker, you're buying a piece of a company. So, understanding the business model, management team, and the industry trends is crucial. But it doesn't stop there. Scientific investing also means understanding risk management. This is where diversification, stop-loss orders, and position sizing come into play.
Position sizing? I've heard about diversification, but not much about position sizing. Can you explain that?
Sure. Position sizing is about how much capital you allocate to each investment. If you're confident in a stock, you might put a larger portion of your portfolio into it, but never so much that it could cripple your overall portfolio if it goes south. It's about balancing risk and reward. Even the best investment ideas can fail due to unforeseen circumstances, so you always need to hedge your bets.
I see. So it's about managing how much you're willing to risk in each trade. But what about technical analysis? I've seen people using charts and patterns. How does that fit into a scientific approach?
That's a great point. Technical analysis is more about market psychology and timing. It uses historical price data and trading volumes to identify trends and patterns. Think of it as studying the mood swings of the market. While fundamental analysis tells you what to buy, technical analysis helps you figure out when to buy or sell.
So, can you combine both? Like, can you do fundamental analysis to find a great company and then use technical analysis to time your entry and exit?
That's exactly what a lot of successful investors do. Combining both gives you a more comprehensive view. For example, you might find a company with great financials and long-term prospects. But if the stock is overbought in the short term, technical analysis can signal that it might pull back soon, giving you a better entry point.
That sounds like a smart way to approach it. But here's a tricky part for me: how do you deal with market noise? There's always news, rumors, and volatility that can cause stock prices to swing wildly. How do you stay focused?
Market noise. That's one of the biggest challenges for any investor. The key is filtering out the short-term noise and focusing on the long-term trends. A lot of that noise is driven by short-term traders and algorithms trying to capitalize on small price fluctuations. But if you're investing for the long term, you need to zoom out. Ignore the daily volatility and focus on the underlying health of your investments.
But what about situations where there's real uncertainty, like during a financial crisis or a recession? How do you invest when everything feels unstable?
During times of crisis, it's important to stick to your strategy and not panic. Some of the best opportunities arise during periods of fear and uncertainty. Remember Warren Buffett's advice: be fearful when others are greedy and greedy when others are fearful. Crises often create opportunities to buy great companies at discounted prices. But again, this only works if you're basing your decisions on sound analysis, not emotion.
That's really interesting. So you're saying that during a market crash, instead of pulling out, you should be looking for opportunities?
Exactly. Crashes are scary, but they also present rare chances to invest in strong companies at lower valuations. However, you have to be careful. Not every stock that's down is worth buying. You still need to assess if the company will recover and if its fundamentals are intact.
That makes sense. So, in a crash, it's not about panicking but being patient and sticking to your long-term plan. But how do you build that patience? I imagine it's hard to watch your portfolio go down and not react.
Patience comes from understanding the bigger picture. If you believe in the companies you've invested in and you know you've done your research, you won't be as tempted to make rash decisions. Setting clear investment goals helps too. If your goal is long-term wealth building, short-term fluctuations won't faze you as much. You have to trust the process.
What about the concept of dollar-cost averaging? I've heard that's a good strategy for dealing with market volatility. Is that something you use?
Yes, dollar-cost averaging is a great way to reduce the impact of volatility. Instead of trying to time the market perfectly, you invest a fixed amount of money at regular intervals, regardless of the stock's price. Over time, this lowers your average cost per share because you're buying more shares when prices are low and fewer when prices are high.
I like that. It sounds less stressful than trying to time the market, which seems really hard anyway.
It is hard, and most people fail when they try. Even the pros can't consistently time the market. That's why strategies like dollar-cost averaging and diversification are so important. They remove some of the emotional stress and guesswork.
Speaking of stress, what about taxes? How do you invest smartly without getting hit by huge taxes every time you sell?
That's a crucial part of the equation. You want to be mindful of the tax implications of your trades. For example, holding a stock for more than a year generally qualifies you for long-term capital gains tax, which is lower than short-term capital gains tax. So if you're constantly buying and selling within short periods, you'll be paying higher taxes on your profits. It's another reason why long-term investing often beats short-term trading.
So it's not just about picking the right stocks but also about making sure you're not giving away too much of your profit in taxes. Is that why some investors use tax-advantaged accounts like IRAs?
Exactly. Accounts like IRAs or 401k allow you to grow your investments tax-free or tax-deferred, which can significantly boost your returns over the long term. It's part of investing smartly, knowing how to make the most of the tax laws to your advantage.
This is starting to make more sense now. It's like a combination of science, strategy, and discipline. But with all the complexity, is there ever a point where it becomes too complicated for an individual investor?
It can feel that way, but the beauty of investing is that it can be as simple or as complex as you want it to be. Some people are content with investing in broad market index funds, which give them exposure to a wide range of companies with minimal effort. Others enjoy the challenge of picking individual stocks and analyzing the market. The key is knowing yourself, what you're comfortable with, what your goals are, and how much time you want to dedicate to it.
I think I want to start with the basics and gradually get more sophisticated as I learn. But do you think AI and algorithmic trading will change the game for individual investors like me?
AI and algorithms are certainly reshaping the market, but they don't mean the end of opportunities for individual investors. Algorithms can process data faster, but they can't replace human judgment entirely. They're also programmed based on certain parameters, and markets can be unpredictable. Sometimes AI-driven strategies can create short-term market inefficiencies that you, as a long-term investor, can exploit. Staying informed and flexible gives you an edge.
That's a good point. So even though technology is advancing, the basic principles of investing, like understanding a company's value and staying patient, still apply?
Absolutely. The tools might change, but the core principles remain the same. Invest in what you understand, diversify your portfolio, manage your risk, and stay disciplined. If you do that, you'll be ahead of most investors.
Thanks, Dad. This has really cleared up a lot for me. I think I'm ready to take my first step into the stock market, but with a much more scientific approach.
You're welcome, Jack. Just remember, investing is a journey. It takes time, experience, and learning from both your successes and mistakes. If you stay curious and keep refining your strategy, you'll do well.
The conversation emphasizes that successful investing blends science, strategy, and discipline. By focusing on data, managing risk, and staying patient, investors can navigate market fluctuations and build wealth over time. Key principles like diversification, understanding tax implications, and leveraging long-term strategies are essential. While AI and algorithmic trading introduce new dynamics, the core investment principles of patience, informed decisions, and long-term focus remain fundamental to success.
Thanks for watching. Remember to subscribe, like, comment, and share to keep the English learning journey alive.